Welcome everyone today. I'll start by acknowledging our Weirdy people of the Wangang and Jangalungu country, who are the traditional owners of the land on which I am today, and I offer my respects to their elders past, present and emerging. Also acknowledge those ongoing efforts to protect and promote Aboriginal and Torres Strait Islander cultures, and it will leave a lasting legacy for future elders and leaders. I also extend that acknowledgement to the traditional owners of the land from wherever you may be joining us today. So, Wadamuli. Today's webinar topic is economic trends to consider when preparing your local government annual budget. Very timely. If you're like me, you're knee-deep in annual budget prep. So today's webinar is jam-packed with key areas of interest and relevant economic trends that may help you, particularly with your forward. We all need to remember to think beyond the next 12 months. So today's presenter is Trent Saunders. I'll read you the very dry bio that we've been given. Trent Saunders is a principal economist, stumbling over my words, principal economist at Queensland Treasury Corp with 15 years experience in macroeconomic research. Trent regularly provides economic and market insights for QTC's clients and investors, and has published widely cited papers on the Australian housing market, commodity markets and monetary policy. I Googled, I found some of your papers.
Thank you.
Yeah. So prior to joining QTC, Trent held various positions in economic analysis and research departments at the Reserve Bank of Australia. So welcome, Trent, and thank you for giving us your time so freely today. We couldn't present these webinars without the partnership of the various government departments and companies who partner with us on these. So Trent and I were chatting before you all joined us, and I asked Trent, how he spends his time outside of what looks like, look, I love all the economic trends and the macroeconomics. I did not fail that at uni at all. But like many of us, Trent and I were talking about how, we're pretty much just chauffeurs at the moment for our children. We might have interests later in life. So I'll hand over to you in a sec, Trent. But just for those of you out in the webinar audience, the session's going to be in two parts, but we'll have plenty of opportunity for Q&A. So please submit questions using the live Q&A button on your screen. And look, feel free to submit them throughout the webinar, and we can have a look at them. Most of the questions will be at the end. We'll let Trent get through his presentation first. So over to you, Trent.
Thank you, Zoe. Thank you so much for that welcome. And thank you all for joining the webinar. So today I'll be providing an overview of some of the key themes that we're seeing across the economy at present, with a focus on what this could mean for your local councils. Now, I often think it's useful to take a step back and think about the macro picture, but it's been particularly useful to do so over the past few years. A lot of the issues that you will be facing in your local regions are likely to be very similar to the issues that other councils are facing across Australia. Things like higher inflation, higher wage costs, and labour availability. These are all issues that have evolved at the macro level. So it's also useful to think about how they might be resolved at that macro level as well. And that will be a large part of my presentation today. In terms of the topics that I'll be covering, the presentation is split between these three broad categories. So first of all, I'll talk about the domestic economy, focusing on things like GDP, the labour market, CPI inflation and wages growth. These last two areas of focus may be particularly pertinent for your budgeting process, given the close link between CPI inflation and wages growth and operating expenses. I'll then talk about the infrastructure pipeline and population growth, and tie this in with the outlook for construction costs, which may be of use for your projections around capital expenditure. And then finally, I'll talk about some of the key risks to the economy with a focus on global risks and the very fast moving changes to US trade policy. So just starting off with the domestic economy, at a very high level, GDP growth has slowed over the past 18 months, and this has largely been due to slower spending from households. And you can see that with the blue bars on this chart. Over the coming year, though, we do expect that growth will start to pick up. And this is really being underpinned by the combination of three factors. So inflation has declined quite noticeably, which has increased households' discretionary income. Second, we saw the tax cuts in the middle of last year, which is starting to feed through to retail sales. And then finally, we've seen the RBA start cutting the cash rate. Now, the path forward may be gradual, but this will also provide a bit of a boost to household spending. And in fact, if we look at leading indicators of consumer sentiment and household spending, these have started to improve in response to these various factors. If you look at the top left-hand side chart, consumer sentiment has increased quite notably. It's still below average, but it's well above where it was at its trough. In the top right, you can see retail sales growth has started to turn around. In the bottom left, households are starting to increase their saving rate again. Once again, it's not back to where we would consider its normal level, which is typically somewhere between 5 to 10%. But the fact that households are starting to do some budget repair and increase their savings rate is a hugely positive development. And then related to this, we can also see that real household disposable income growth, so income adjusted for inflation, has also turned positive. So these are all positive signs for household spending going forward, and is a key reason why we expect GDP to start to turn around over the coming year. Another factor that is underpinning this turnaround is the ongoing strength in the labour market. Nationally, the unemployment rate is 4.1%. In Queensland, it's even stronger at 3.9%. What's even more striking, though, is that over the next few years, unemployment is expected to remain at 4.2%. So the orange line in this chart shows forecasts from the RBA's February statement on monetary policy. Now, if you look historically, the last time we saw an unemployment rate this low was during the peak of the mining boom. So this was a period of time in which the labour market was incredibly strong. If we were to go back further, the second last time we'd seen an unemployment rate this low was 1974. So the fact that the RBA thinks that we can sustain an unemployment rate of 4.2% over the next couple of years, with inflation moving back towards the target, is an incredibly positive development for workers within the economy and the economy more broadly. Now, this strength has not only been seen at the national level, but we've seen it across most regions as well. So I might explain what this chart is showing. The blue bars show the unemployment rate over the past year for each of these SA4 regions across Queensland, while the orange dots show the decade average. So across all of these regions, the unemployment rate over the past year has been at least in line, but in most cases far below its decade average. So the gains that we've seen within the labour market really have flowed through to different regions across the state. Now, this is at the SA4 level. We also have data at the local government level, so the LGA level. Apologies, I'm sure many of you aren't able to read the text at the bottom of this slide. I certainly can't. The key point here, though, is that what we saw on the previous chart still holds when we look at the LGAs. So the unemployment rate for each LGA in September quarter of 2024 was below the decade average for that same area. Now, this is a hugely positive development for workers and those that are engaged in the labour market, but it does pose some challenges for employers and those trying to organise large projects. So a very common theme that I've heard from councils and organisations across the state as I've done these presentations is that labour market shortages have persisted. Now, given the current strength in the state's labour market and the outlook for the labour market to remain quite strong going forward, is that these labour shortages, the difficulties that you may be having in finding, retaining, or recruiting new workers is going to continue at least over the next year, if not the next 2 years. Now, this strength in the labour market has also flowed through to wages growth. And you can see that with the orange line on this chart. Wages growth has eased a little bit from its peak, but it still remains well above where it was prior to the pandemic. Now, the RBA is forecasting wages growth to fall to 3.4% in financial year 2025, then 3.3 and 3.1% in FY26 and FY27. Now, I know that most councils will have EBA agreements in place, but if you are thinking about a longer term level for wages growth or running some sensitivity analysis around longer term outlooks for your budget, then having wages growth somewhere between 3 to 3.5% would be a reasonable assumption. Certainly, that's where most economists see wage increases settling. Now, on inflation, this is also going to be very important for your budgets, given its close relationship to operating expenses. Inflation has fallen back to be within the RBA's target band. It's currently 2.4%. Looking forward, headline inflation is expected to be a little bit volatile, and you can see that on this chart. And this is just due to various electricity subsidies starting to roll over. Even on an underlying basis, so if we were to look at the RBA's forecast of trimmed mean inflation, which abstracts from all of this volatility, they have this coming down to 2.7% by the middle of this year, and then remaining at this level thereafter. So the RBA and most economists are expecting inflation to sustainably return to its target band over the coming year. Now, with inflation improving, the RBA has already started its cash rate cuts for this cycle. We saw the first 25 basis point cash rate cut in February. The expectation is that there will be further cuts going forward, but the pace of these cuts could be quite slow. So financial markets are expecting 2 further cuts over the course of this year. That's also our forecast. And in fact, it's the forecast for most economists. So it is the consensus view. Our expectation is that the first or the next cut will occur in May with a follow-up in August. There is a risk that this is delayed. So there's a risk that we don't see any further cuts until the second half of this year, with the most likely timing them being August and November. So overall, inflation has improved, and this will be providing some relief for households, and it will be providing some relief for those putting together council budgets. There are some elements of inflation, though, that remain high. So we haven't seen this improvement across all of the different indices within the CPI. One area that may have importance to local councils will be housing rents. So CPI housing rent growth remains very high. It remains high at the national level, the state level, and the city level. The reason for this is quite clear. If you look at the chart on the right, you can see that the rental vacancy rate remains very tight, and is well below where it was in the decade prior to the pandemic. Now, these data are only for Australia and Brisbane, but strong rent growth is something that we've seen across most regions within the state. So this shows the average annual rent growth from Q3 2020 to Q3 24, so over the past 4 years, for these different LGA regions. So you can see that the vast majority of regions have had annualized rent growth above 8%. Now, wages growth have picked up, and that has been a positive for households, but wages growth hasn't picked up by 8%. So this would have been putting quite a lot of pressure on households' budgets, and going forward, it will continue to be one of the areas where we do see continued pressure from a cost of living perspective, simply due to it taking some time to restore the supply-demand balance in the housing rental market. So that is a fairly broad overview of some of the key macro indicators that we're looking at and how that might translate to both your budgeting process and to your local areas more broadly. I'll now just turn to a few slides that I've put together on the infrastructure pipeline and population growth. So the major project pipeline has varied quite a bit across the states. New South Wales and Victoria appear to have reached the peak of their pipeline, with spending expected to start to decline from here on out. Queensland, on the other hand, is still ramping up. So this chart is provided by ANZ in its Australian Major Projects reports. ANZ expects Queensland will account for more than a third of the increase in national project activity over the next 5 years. There's expected to be a very large increase in project spending in financial year 2026, which you can see on this chart. And this is driven by predominantly by spending in the electricity sector. The major project pipeline then is expected to peak in financial year 2027, and it remains quite elevated thereafter. In fact, if you were to take ANZ's estimates at face value, Queensland's potential pipeline over the next 5 years is more than double that of the past 5 years. So this obviously is going to put pressure on some key inputs in delivering these projects, one of which is labour. So the growing pipeline of projects is going to see strong demand for labour across the state. QMCA estimates that the average labour demand for delivering this pipeline of work will increase from around 16,500 workers this financial year to a peak of around 38,500 workers by financial year 2027. So once again, this is more than double where we are now. What's even more notable, though, within the QMCA report is that regional areas are expected to see the largest increases in demand. And you can see that on this chart. So, for example, QMCA estimate that Fitzroy, Wide Bay, and the broad Mackay-Isaac Whitsunday region will require over 4,000 workers on average over the next 5 years to deliver the projects in these regions. Now, I must admit that I'm not a specialist in this area, so I can't specifically vouch for the precision of the QMCA numbers. But the broad story is consistent with the results from other institutions and reports as well. So one such institution is Infrastructure Australia, and you can see one of their key charts on this slide. So Infrastructure Australia has found that while labour shortages appear to have peaked in capital cities across Australia, they are still rising in regional areas. Now, this chart is at the national level, but the report also speaks about some of the state results. And Infrastructure Australia note that this divergence is even more pronounced in Queensland. So that's to say this disparity between the cities and regional areas is even starker in Queensland than what we can see on this chart. Now, in terms of what's driving this demand, energy projects driving the growth in workforce demand over the next 5 years, with the top 5 occupations being engineers, construction labourers, electricians, plant operators, and project managers. So it's really a broad-based set of occupations across these projects where there's going to be shortages. It's not one particular area. Now, the big question is, what does this actually mean for cost inflation? So cost inflation has slowed from its peak, but it's still running notably higher than it was prior to the pandemic. Now, the QTC research team puts together forecasts for both road and bridge construction costs and non-residential construction costs at the national level. And you can see these as the dotted lines on this chart. We see construction costs in general remaining above CPI inflation over the next 5 years. And this is due to the large pipeline of work over this period, continuing to put upward pressure on demand for labour and other inputs. So overall, our forecasts have both road and bridge construction costs and non-res construction costs settling somewhere around 3 to 3.5%. Now, of course, this increase in infrastructure spending has not appeared in a vacuum. A key driver of the state's increase in infrastructure has been the surge in population growth that we've seen over recent years. So Queensland's population growth is forecast to ease from this peak, though. So we have seen a large increase in population growth. It is expected to ease in response to changes to the federal government's migration strategy. By the end of the forecast horizon, it's expected to settle somewhere around 1.25%, which would be considered a long-run average level, so a more sustainable level of population growth. Now, this slowdown in population growth will eventually lead to slower demand for infrastructure and slower demand for housing, but there remains backlogs in both of these areas. So the effect of lower population growth is unlikely to be immediate, and it could take some time for this backlog of demand to be worked through. So that takes me to the end of the domestic side of the presentation. I might change it up a bit now and focus a bit more on the global outlook, with a particular focus on some of the key risks we're seeing around the US changes to trade policy. So higher US tariffs have been put in place a lot more quickly than basically everyone expected. Now, there's going to be the direct impact of these tariffs on growth and inflation, but apart from this direct impact, there's also likely to be elevated uncertainty around US policy, and this in turn could weigh on business investment and consumer activity. And in fact, we've already started to see this in the US consumer survey data. So growing concern about the impact from higher tariffs and other policy changes has seen US consumer sentiment fall to a 2-year low. You can see that in the chart on the left-hand side of this slide. What's even more striking, though, has been the increase in consumer inflation expectations, which is on the right-hand side chart. So 1 year ahead inflation expectations is spiked to 4.9%, from what was just slightly above 2.5%. While long-term inflation expectations has increased to 3.9%. So it's very clear that US consumers have become concerned that higher tariffs will lead to higher US inflation. And if you look at the potential magnitude of the tariff increases, it's really not that hard to see why. So this chart just provides some context around how large Trump's policy announcements have been. So if you look at the chart on the right, this shows the US effective tariff rate. That little blip up that you see in 2019 was due to the US-China trade war in Trump's first term as president. The slide on the right is a bit complicated, so I apologize for that, but it's provided by Goldman Sachs, where they've estimated how this effective tariff rate could change in response to various announcements. Now, I won't go through all of the details, and things have changed a bit since then, but at this point in time, Goldman Sachs thought that the effective tariff rate could increase by as much as 15 percentage points. So this would take it to 17.5%, or its highest level since 1940. Now, thankfully, we don't expect that to happen. There are lots of reasons why it won't or shouldn't increase by that much. But still, given the announcements today, it is quite easy to come up with scenarios in which the US effective tariff rate increases to somewhere around 7.5% to 10%, if not higher. So these are very large changes that the US is putting through in terms of its involvement with the global economy. Now, the direct effect of these tariff increases on Australia is likely to be quite small, and this is for two main reasons. First of all, Australia is not a particular target of these tariffs, so the focus has been more so on Canada, Mexico, the EU, and of course China. And the other reason is that even if we were a target, we don't export that much to the US. So this chart is for Queensland, but the numbers are similar for Australia. So Queensland's goods exports, the US accounts for around 3% of these. So you can see that as the blue bar at the bottom of the chart. For Australia, I believe it's closer to 4%. In either case, the direct impact of higher tariffs is unlikely to be that material. What could be more material is the indirect effect on our major trading partners. So around a third of Australia's goods exports go to China, and around 25% of Queensland's goods exports go to China. So potentially a slowdown in China could see less demand for our exports and slower than expected economic growth. If the slowdown is isolated to China, there are strong arguments that we could be able to divert a lot of our major shipments to other buyers that we have strong relationships with, like South Korea, India, and Japan. But our ability to divert these shipments is going to be impeded if there's a more general global economic slowdown. So if the tariff increases not only see China slow down, but we see a slowdown across other major export destinations as well. So this is really the key risk to the Australian economy from what we've seen. In terms of some of the other impacts, so the key risk to the Australian economy really is on domestic economic growth, with this coming through the potential impact on our trading partners. The effect on Australian inflation is a bit more ambiguous. So higher US tariffs will add to US inflation, so that bit is very clear. But that doesn't necessarily mean Australian inflation will increase too. And in fact, lower growth could start to put downward pressure on our inflation rate. Now, I could do a whole presentation just on this issue, but the key point here is that in terms of the risk to the outlook from the trade war, these risks are much more heavily skewed towards lower economic growth than they are towards higher inflation in the Australian context. So I actually had someone recently ask if they should be factoring in higher inflation due to the trade war in their budget projections. And for headline CPI inflation, the short answer is no. If you're taking your inflation forecast from a reputable forecaster, such as the RBA or Consensus, then they will already be accounting for the effect of these higher tariffs. And so far, this effect is expected to be relatively small. With that said, the big caveat is that it gets a bit murkier if you start looking at individual cost for individual products, particularly those sourced from the US. So in that case, you'll have to take it on a case-by-case basis. And then a final key point to remember is that the exchange rate will play a key role in the adjustment to any global shock or surprise that may come. Now, we don't explicitly forecast the exchange rate at QTC, but I can show these forecasts from other economists. So the forecasts on this chart are from Consensus, which is basically an average of a range of different projections that have been provided by different economists across financial institutions. The consensus view is that the Australian dollar will remain around its current level in the near term. Normally, you would expect that in a period where there's a lot of uncertainty, the US is increasing tariffs, and China's economy is slowing, you would expect the Aussie dollar to depreciate. But in this instance, this seems to have been offset by concern about US growth prospects, following a run of negative data prints and just the high level of uncertainty about exactly where US policy is heading. Looking beyond the next few months, consensus has the exchange rate starting to appreciate. And this is seemingly due to the expectation that growth will continue to slow in the US. Now, one final point is that forecasting the exchange rate at any point of time is extremely difficult. In the current situation where we're getting new news flow on a day-to-day basis, it's almost impossible. So this consensus forecast is based on the outlook from lots of different analysts. We at QTC speak to a lot of these analysts, and when you ask them about their outlook, very few people have strong conviction about where we're heading. So this just really highlights the high degree of uncertainty and risk that we're seeing in terms of the global outlook. So overall, the outlook for the Australian economy and inflation is quite positive. GDP growth is expected to strengthen over the coming year, and underlying inflation is expected to settle within the RBA's target band. This return of inflation and wages growth to a more sustainable pace should also see council costs return to what would be considered a more normal growth rate. There will still be challenges in the period ahead, though. Labour market conditions are projected to remain strong, impacting labour availability across most regions. Construction cost growth is also expected to remain a bit higher than usual due to the major project pipeline. And of course, the impact of an escalating trade war is a key risk to the outlook, not only for the state, but for most economies across the world. So that takes me to the end of the presentation. Before I open it up for questions, I would also like to quickly mention our QTC education program. So we continue to support local government with our education offerings, and we invest to make this program accessible and affordable for councils. We offer education for elected members, executives, and council staff on all things financial. So we will be delivering more economic updates throughout the year, so you can keep an eye out for this as well. We are currently refreshing the program in partnership with the Department of Local Government. So you should keep an eye out for education offerings that will be announced over the coming weeks and months. Equally, if your council has some unique needs, we are very happy to have a discussion on how we can help with that. So that takes me to the end of the presentation. I'm happy to open it up to questions, see if there's any questions on the chat.
Okay, wow. Do you know what? If I'd actually had a lecturer as engaging as that, I may not have failed macroeconomics the first time. You make it sound so interesting. So if you have a question, please go to the live Q&A button that you'll find on your screen and submit it. This is a unique opportunity to, if you have got a question based on some your LGA as well. So we have our first one has come in. We've got, so it says, we have increased our CapEx budget by 3% for year 2 and year 3, then dropped it back to 2.5 for the remainder of the forecast. So this would be your long-term financial forecast. Do you think this is reasonable based on the construction cost forecast? You did say about 3 to 3.5 and an infrastructure pipeline. So have they increased it enough? Should they drop it back?
So as with all of these forecasts, it's what I'm presenting is at a very aggregate level. So on average, what I'll be presenting provides a baseline against which you can cross-check some of your assumptions. But when you get down to your local areas, it's really going to be driven by the unique circumstances that you're facing. So in terms of your total CapEx budget, that will be a function not only of cost inflation, which was what I was showing, but also the volume of work and whether the particular projects that you're running or looking at are in higher or lesser demand than average. So overall, it's difficult to say without looking at the details whether it's appropriate or not. But hopefully the numbers that I've provided provide a bit of a benchmark for you to cross-check your assumptions around just the cost escalation for things like materials and labour costs.
Okay, question 2. Where could a council find the information on migration specific to their LGA area?
That's a great question. The ABS does provide local government population data, which I believe is split between the various drivers of population growth. So you can look at net overseas migration or net interstate migration as well. This data is not particularly timely though, so that's the main issue. It's at an annual basis, and I believe the most recent data are up to financial year 20. I'm not sure if 2024 has come out yet, but I think financial year 2023, maybe financial year 2024 has come out. But there are data available on the ABS website. If you want me to point you in the right direction, please feel free to contact whoever your contact is at QTC, and we can help you with that request.
Okay. So look, we still have Trent available to us for at least another 20 minutes. So now's the time if you've got any curly questions, and there's no, if you're new to local government and this is all new to you, just, don't be afraid to ask the question. What I found very interesting is, because this is, we have a regular update at our forum and at our annual conference. So every 6 months or so, we're seeing these QTC updates. And what I've found interesting is what's happening with that infrastructure backlog and the pipeline and the impact on our councils, particularly outside of the southeast corner, how we need to actually start thinking about investing a lot more into our planning part of our projects, and how we educate councillors and the people making the decisions around those timelines, that there are legitimate reasons why we may not be able to finalise a capital project as we'd planned, and why the increases in cost are coming along. But what is a little bit scary, particularly outside the southeast corner for me from your graphs, is just seeing that where the gaps, the skills gaps, and the low unemployment rate, particularly in the regions, with the very low rental occupancy vacancy rate as well. That's a little bit scary about how can we as councils through our budgets look to manage this, and in some cases influence some changes or slowing of things, particularly with they don't align with grant programs that are coming out. Build big infrastructure. So, any thoughts about, particularly outside of that southeast corner, how we can manage this?
It's a big question. As you mentioned, there are a lot of things that have all kind of coalesced together to make this situation quite difficult. So the combination of just an overall strong labour market. So there's not that much in terms of labour market slack or people that are wanting to find work but can't find it. So we don't have that captive labour market. We've got a strong pipeline of work, trying to encourage people to the regions to do that work. And you're trying to encourage them to do so at a time when there's housing shortages. So you put all of those factors together, and certainly you can see why it's such a challenging environment. From a budgeting perspective, I think that you need to be cognizant of that broader environment and the fact that costs may escalate more than what you're expecting. So even if you have a central view of the budget, some sort of sensitivity analysis or thoughts around, okay, what if costs were to escalate to X% instead of where we have it? What would that make our budget look like? And think through those scenarios and how you might respond. So I think just, honestly sitting down and working out what is achievable and some of those key risks would be a great starting point. In terms of trying to enact any sort of change, that is really going to come down to the circumstances of the local region. So I'm not sure how you might go about that one.
It's a tough thing for us to consider. So looking at those gaps, and particularly in that labour market as well, and the future gaps out in the regions, particularly in that project management area. And a lot of us, we have to buy in the project management expertise because we don't, we struggle to attract, retain, and have people with those skill sets. QTC with their education program, I know project management, or at least whole of life costing and all of those sorts of project management tools have been a focus of QTC. Are you aware of, with the refreshing of the education, if there's a emphasis on that project management fundamental skill set, so that we can look at maybe growing some of our own out in the regions?
I would have to defer on our education program on that. Certainly it is an area where we would be willing to help clients. But in terms of the specific programs offered by our education program, I would have to defer to Rory on that one.
Sounds like something that we can take on notice. That is it's a skill set. As finance professionals, sometimes we don't think around the budget skill, the project management type skill set, but it's what we do on a daily basis. Our budget is a project, and if we look at approaching it that way, it's a potential divergence into that skill set and grow our own to keep people in the regions. Wow, it always blows me away every time I see all of the different statistics. So here's an interesting one for you. How worried should we be about the federal budget for Queensland next week? So yes, any thoughts on the federal budget, and are we excited in Queensland? Are we concerned? Any thoughts?
I am somewhere between the two. I mean, the budget time is always interesting because you never know exactly what will come out. In terms of the state government revenues, though, a lot of the grants from the federal government to the state are, there's the GST, which we've already seen some changes around that recently, but the special purpose grants is something that is quite hard to predict, but at the moment we're not expecting any major changes from what is currently in place. But that would be the key area from a state perspective that we would be looking at. In the broader budget context, yeah, it's always a fun night. There is also another question that I've seen come through. So
we've got a few there coming through now.
So there's one. Do you think the recent weather events in Queensland would result in higher than anticipated cost increases for critical projects due to skill shortages? I think that this is an area where we'll have to wait to see the final cost and how much work needs to be done. Thankfully, it didn't end up being as severe as what was initially anticipated, which will help with this. What we've seen previously is that there have been some cost effects related to, just say, the 22 floods. We did see costs for different materials increase in response to that, but those cost increases were fairly short-lived. So even if there is a bit of an increase in cost due to a lack of material availability, we wouldn't expect that to persist over the coming years. That would be something that would only really be in place while that work was being done, and then things would return back to normal. So in the short term, maybe you might want to consider that, but over a whole financial year, or if you're looking at medium-term forecasts, the effect is likely to be quite small from a cost perspective.
Okay, so we thank you for that one. We've got a couple more questions so far. So this is along the lines of talking around those capital projects. So with the high demand for capital projects in the next 2 to 3 financial years and limited cash availability, so based on the economic forecasts, would you recommend delaying projects or increase borrowing to do them now? That's 2 different ways of looking at it, is it?
Yeah.
Delay and do later and have the cash later, or borrow and try and get them done now.
That is another one where it is really going to come down to the specifics of that project and how tight the deadline is on completing it. So at a high level, the thought process is this a project that needs to be delivered by a certain time? Is this something that we need to complete? And if we delay, is that risking that timeline? If there is no firm deadline on delivering a project, then certainly delaying a project could be some way to alleviate some of the cost pressures and really just wait and see how things play out. Now, the right decision to make is going to depend very much on the specifics of that project, so I can't give any specific advice. But in general, that's the thought process I'd be looking at. And certainly, I mentioned the Infrastructure Australia report over the course of my presentation. If you look in that report, each year they provide this really interesting chart where it shows the current CapEx profile nationally compared to their estimate from the previous year. And you can see that over successive years, the pipeline has tended to be pushed out and smoothed. So back 2-3 years ago, there was a very distinct peak in the CapEx profile nationally. That peak is gone. The total spending has actually increased due to cost escalation, but it's a much smoother profile. So that thought you were having about whether to delay, that is something that when we see these large pipelines of work, lots of different organisations, not only within the state but across Australia, choose to follow that option.
Okay, so we've got one more here. What should councils be forecasting for cash rates, or should they be aligning to forecast inflation?
So if you have the cash rate as an assumption within your budget, then 2 further cuts over the course of this year is very much the consensus view. So it's the view of financial markets, and it's the view of consensus economics. It's also QTC researchers' in-house view. So that would be an assumption that would be very easy to justify. In terms of the inflation forecasts, the financial year forecasts that I provided on that slide were from the RBA. So they are a very reputable forecaster. Certainly, you can justify using that outlook. The one potential issue with using forecast for headline inflation at the moment is that there is that bit of volatility over the forward estimates due to the effect of electricity subsidies on CPI inflation. If you don't think that your operating expenses or the items that you're using CPI as a proxy for will be affected by those subsidies in the same way that it shows, then using something like an underlying measure of inflation or averaging those inflation rates over the following years may be a more appropriate way to go about this. So I wouldn't deviate too far from what would be considered a consensus view of inflation, but there are circumstances where you may want to tweak, say, the RBA's forecast or the consensus forecast if you think that it's not representative of the cost pressures that you may be facing.
So looks like we almost come to the end of our webinar, but one more thing that I'm thinking with just having a look at how we were talking about households, household confidence, people are starting to save, people are starting to spend, but with the caution of the rental increase and the low vacancy rates. When we're thinking about our ratepayers, and usually the last thing they pay, depending on the demographic, the last thing they pay is the rates. Yep. Do you think with that increase in consumer confidence that we're going to see that across the board? With those, so I guess what I'm getting at is when consumers are stressed, that's when our ratepayers are stressed. That's when we need to be more cognizant of those household pressures. But with low unemployment rate, higher increase consumer confidence and spending, then theoretically we should see people having that, I guess, more available income to pay those bills. So yes. Is that the right assumption that we should see from those graphs?
Definitely. Household balance sheets and the household finances will still be under pressure. So the process of recovering from the high inflation period has started, but it will take some time before we get back to normal. Still, it is improving. So we are seeing real income start to increase once again. We are seeing households start to save once again. Consumer sentiment start to increase. Within that consumer sentiment survey, one of the largest drivers of that increase is a component that's called households' perceptions of their personal finances. So there's been a large increase in household perceptions of their own personal finances. So all of these indicators are suggesting that as households start to go through this process of recovering their household balance sheets, they will be better placed to pay their rates on time. So the amount of delayed payments or issues you may have collecting payments should start to ease over the coming year or so.
Okay. Well, thank you, Trent, for the presentation. And thank you everyone out there in webinar world for your attendance. A copy of the webinar recording will be on our YouTube channel over the coming days.